So let's talk about the 529 plan today. So 529 plan is one of several tax advantaged way to pay for your kids' college education. So Coverdell ESA and US savings bond interest to pay for college education tax-free are other options, but they come with substantial limitation. So they're not as frequently used as the 529 plan. This video is sponsored by Dr. Yasmin Proctor. She would make horchatas and carnitas for creation of this video. So let's talk about what 529 plan is. So a 529 plan is qualified tuition program whose rules are found in Internal Revenue Code section 529. That's why it's called 529 plan. Similarly, the 401k, the retirement plan that we all heard of, is found in Internal Revenue Code section 401. So that's why it's called 401k. Not very creative way to name things. So there are two types of 529 programs. So the first one is prepaid plan, which essentially allows parents to prepay in-state college tuition in advance for today's rate for their kid, assuming that their kid would end up going to one of those participating in-state colleges. So the other type is savings plan, which is what most people understand a 529 plan to be. So I'll talk about the 529 savings plan today. So let's start with the main tax benefit. So in a nutshell, the main tax benefit is that you can pay your kids' college tuition with tax-free earnings. So tax-free earnings. So for example, say that you contributed $50,000 of your after-tax money into your child's 529 plan, and you invest that money wisely, and it grows to be 200K. So started with 50, now is 200K. So in that case, you're going to have $150,000 of earnings from your investment, right? So if you withdraw the entire $200,000 of balance to pay for your college education, then $150,000 of the earnings will be tax-free. So key is tax-free earning, and that's the main tax benefit. So note, when you contribute money into 529, you'll have to use your after-tax money. So there's no tax deduction that you get when you make that contribution at the federal level. Some states give you a state level tax deduction when you make a contribution up to a certain amount, but California isn't one of them. So next, you may wonder, how much can you contribute to your kid's 529 plan? So bottom line, it's a lot. You know, the actual limit varies by state, since the 529 plan is state-sponsored program. So, but most people won't really have to worry about the maximum amount, the limit, because the max ranges from 300K to $500,000. So for example, California's 529 plan allows a maximum contribution of $529,000 per kid. So if you're a big baller, you may consider contributing a lot of money to your kid's 529 plan early and call it a day. You can do that. But so if you decide to contribute, say, $500,000 as a lump sum to your kid's 529 plan in 1 year, you can definitely do that, because it's going to likely fall below the limit, but it will trigger a gift tax return filing requirement. So let's talk about the gift tax return for a little bit. So to most everyday people, gift tax or filing a gift tax return really won't have any adverse tax consequences because the current gift tax exemption amount is $13.61 million, which means you can give up to $13.61 million during your lifetime and at death combined without needing to pay any actual gift tax money. But this exemption amount changes annually, but it's going to drop to about $7 to $8 million in 2 years because the current $13.61 million limit was a temporary bump due to the Trump tax reform in 2018. But historically, the limit has increased over time. So the bottom line, if you got less than $7 to $8 million to give during your lifetime or at your death, you should be okay. So another important fact about gift tax is that if you give any single individual a gift worth more than $18,000, which is the annual gift tax exemption amount in 2024, you will have to file the IRS Form 709, which is called a gift tax return. So, and if you give a gift greater than $18,000, the excess above the 18 grand will reduce your $13.61 million of exemption amount. So let me give you an example. So say that you want to give your niece 28 grand, which is $10,000 above the annual gift tax exemption amount, which is 18 grand. Then your gift tax exemption amount will drop to, listen, $13.6 million from $3.61 million. Not a big deal to most people. So for 529 contributions, you can contribute 5 times the annual gift tax exemption amount without reducing your lifetime gift tax exemption amount, which is $13.61 million. So if you're a parent, you can contribute $90,000 this year, which is $18,000 times 5 to your child's 529 plan. All you have to do is just file the Form 709 and you will get to keep $13.61 million of lifetime gift tax exemption amount to use later. So if you're married, you and your spouse can contribute whopping $180,000, which is $90,000 times 2 to individual, to your child's 529 plan at once and preserve the lifetime gift tax exemption amount. So let's talk about the types of expenses that qualify for tax-free withdrawal of 529 money. So they include tuition for essentially all accredited public and private post-secondary institution like college and vocational schools as well. And the 529 money can be used to pay for K-12 tuition, but only up to 10 grand tax-free a year. So additionally, books and supplies and reasonable room and board, if your kid is at least half-time student, can be paid for with 529 money, tax-free, penalty-free. So what if you use the 529 for non-education, non-qualifying expenses like buying a car for your kid? So there will be 10% penalty under earnings. That's a key, under earnings, not on the after-tax money that you contributed to the 529 account. So you won't get tax or penalty twice. But your state may impose a penalty as well. For instance, California, where I live, they're going to impose 2.5% penalty under earnings used to pay for non-qualifying education expenses like buying a car for your kid. So California also considers K-12 tuition as non-qualifying education expenses. So they're going to hit you with 2.5% penalty on the earnings used to pay for K-12 tuition. So one common concern that parents may have is, what if my kid is so smart that my kid gets full ride to Harvard or Stanford, and we don't need to use our 529 money. So what can we do with the extra 529 money? It's a good problem to have. So shout out to my niece Claire, who got a full ride to WashU. Yay! So if you got extra 529 money, like my niece Claire, so you have 3 options. So option number 1, transfer the extra money to another family member without incurring any taxes or penalties. Option number 2 is withdraw the money and pay taxes and penalties on the earnings. So option 3 is an exciting one. Roll the extra 529 money to your kid's Roth IRA, which is an amazing option. So this option was made available in 2024, this is first year, via Secure 2.0 Act, which allows a total of $35,000 during one's lifetime to be rolled over from 529 to a Roth IRA, tax and penalty free. But there are several requirements that must be met for the 529 to Roth IRA rollover. So requirement number 1, so 529 account has to be at least 15 years old when the rollover happens. So open it early. So number 2 is the money contributed to the 529 in the 5 years before the rollover cannot be included in the rollover. So for example, if your kid's 529 plan was created 15 years ago, then contribution made from year 10 to year 15 cannot be rolled over to the Roth IRA. This essentially incentivizes parents to open and fund the 529 as early as possible. So number 3 is a maximum amount that can be rolled over is limited by annual IRA contribution limit. So in 2024, you can contribute a maximum of $7,000 to your IRA annually. So that's an annual IRA contribution limit for 2024. So to roll over $35,000 from the 529 to Roth, it would take 5 years, assuming that the annual IRA contribution limit remains at $7,000, because $7,000 times 5 is $35,000. So while doing this rollover up to the annual IRA limit, you cannot contribute any additional money to your Roth IRA since you have already maxed out on the annual IRA contribution. So requirement number 4 is your kid will need to have earned income to be eligible for the rollover in the year that they do the rollover. So generally, to contribute to an IRA, you'll need to have earned income like salary or 1099 compensation. So your kid must earn at least $7,000 if they want to roll over $7,000 from 529 to a Roth IRA, for example. On the side note, some states, like another California thing, does not allow this rollover. So the earnings from the rollover will be taxed and subject to penalty. So in summary, a 529 plan is a great tax advantage way to jumpstart the funding of your kids' college education. So if you can, start opening and funding it as early as possible so that if you have any extra leftover 529 money, it can be rolled over to your kids' Roth IRA. Hope this was therapeutic, and I'll see you at the next tax clinic.